Hello everyone, it's Boss Economics World, where we analyze where your money is going, and what dark alleys the government is dragging the economy into. Welcome to today's episode, and oh boy, do we have a big one. We dive deep into the tremors rocking none other than the US Treasury bond market. Looks harmless at first, right? Some government bonds, long-term interest rates creeping up, nothing you shouldn't expect after years of fiscal mismanagement, but folks, when you peel back the surface, the consequences are sinister and far-reaching. Yes, I said it. Terrifying might actually be the better word. Get comfortable because we're seeing a grotesque cocktail of bad economic policies, political dysfunction, and global spillovers that could lead us straight into the next financial crisis. And with Trump administration 2.0 looming on the horizon. This is like watching a slow-motion train wreck. Alright, let's start with some context. Treasury yields are on the move. Historically, government bonds should be one of the safest investments around, a snooze fest for most retail investors. But the US Treasury bond yield, a darling of global investors, has surged to levels not seen since the early 2000s. The 10-year yield, specifically, rose more than 1 percentage point since September, nearing 5%. This looks like just a little bump up, right? Wrong. It's more than a wake-up call, it's a serious warning signal that the house of cards built by those sitting in Washington is toppling at breakneck speed. Why does this matter? Because bonds serve as the bedrock of global finance. When bond yields jump, borrowing costs for governments rise, and this isn't just the US, it's happening globally. Higher interest payments on government debt trickle into higher corporate and personal borrowing costs, slowing down growth, but more on that later. In addition to America's bloated deficit financing, what we're witnessing is the unraveling of decades of low-interest rate policies, fueled by nearsighted fiscal decisions. And here comes the real kicker: if long-term yields hit the 5% mark or beyond, borrowing for everyone, from governments to mortgage holders, is going up. What does that mean for you? Higher mortgage rates, pricier car loans, and yes, the stock market tantrums you're used to seeing during a crisis. You might hear people finger-pointing, as usual, blaming macro factors or cyclical adjustments. Let me cut through the jargon. This mess is the result of painfully short-sighted economic policies that began in the Trump era, policies that were supposedly aimed at making America great again, but, in reality, fueled extreme imbalances in the economy. Let's look closer. Trump's tax cuts in 2017 generated an unsustainable federal deficit, we're talking trillions added to the national debt. And while it was great for propping up the stock market and enriching the wealthiest 10%, the long-term consequences are now surfacing right before our eyes. These tax cuts ballooned federal debt, and guess what? Someone has to pay for this profligacy. Enter, the American taxpayer, and you guessed it, bond investors. Rising borrowing costs and today's ballooning deficit are on a collision course, reaffirming the fiscal time bomb set during Trump's first term. Let me give you an example. In 2020, during the height of the COVID-19 pandemic, the US government's severe need for cash meant they flooded the market with Treasury bonds to raise funds for stimulus after stimulus. Yes, these measures were necessary to prevent an economic meltdown, but the result was a dangerously rising debt-to-GDP ratio. We hit 100%, folks. Meaning? The government owed as much as the entire size of the economy. Imagine your credit card debt being as big as your annual household income. Makes you sweat, right? Well, that's where the American economy stands right now. And now the market's tolerance for ballooning debt is wearing thin. Investors are demanding higher and higher yields to take on the risk, driving interest costs up, exactly what we're seeing in the current bond market. But wait, here's the kicker: interest payments on just the US debt are already over $650 billion annually, and rising. That's more than we spend on education, infrastructure, or most other federal programs. It's only going to get worse as rates climb. Now, I hear some of you asking, why should I, sitting here in Asia, care about US bonds or Trump's policies? Well, for those thinking they're immune to this, think again. The US Treasury market is the foundation of the global financial system. When America sneezes, the whole world catches a cold. Zooming out, higher US bond yields spell doom for emerging markets, who often borrow in dollars. With higher interest rates, their repayments on dollar-denominated debt skyrocket, leaving them crushed. Emerging nations, especially those in Africa and Latin America, are already alert to a new debt crisis looming. We're already seeing capital outflows from these nations as investors opt for safer US assets with higher yields. What does this mean? Slower global growth, higher inflation, and political instability. A perfect storm that nobody seems to be taking with enough seriousness. European countries aren't faring well either. The European Central Bank is already caught between trying to tame inflation and stabilizing the bond markets, and the higher US yields are putting pressure on European bonds. Mortgages, loans, and any other debt instrument linked to longer-term rates will become increasingly unaffordable. Take Germany, the powerhouse of Europe. Its 10-year bond yields recently rose to over 3%, an alarming level for an economy already teetering on recession. Stagflation, anyone? On the ground, this will mean Eurozone economies slowing even more than expected while inflation continues to claw at households' purchasing power. Then we have nations like Italy. Higher borrowing costs there will only exacerbate what's already a concerning public debt issue, nearing 150% of GDP. If you think this is just a US-centric issue, wait until the European banks start to suffer from cascading bond market instability, something that could mirror the 2011 Eurozone debt crisis. Everyone's keyed in on inflation and interest rates, but few are sounding the alarm on how the bond market is the linchpin that could bring the whole house of cards crashing down domestically and abroad. So let's talk politics for just a second. Some in Washington, believe it or not, are still sleeping at the wheel. Bloomberg's recent Trumponomics report underscored that while the party politics around Trump might shift momentarily, that doesn't. And if Capitol Hill thinks they can continue kicking the can down the road, they've got another thing coming. With the Republicans soon to control both houses, yes, that's right, it's going to be a razor-thin situation. Trump's agenda this time around? Let's just say it's sitting on thin ice. Kate Davidson, Bloomberg's managing editor for U.S. economic policy, rightly noted that rising yields could throw a wrench in the process of Trump's proposed plans. And I've got to agree, try pursuing aggressive, borrowing-driven policies when the market is already screaming at you, and Congress is bitterly divided. If rates continue climbing, resistance inside the Republican Party to spending more will grow louder. But even if they try aggressive spending cuts, it's too late to avoid the debt trap we're in, either fed by Trump-era tax cuts or pandemic-era stimulus overextension. As the bond market moves into this uncharted territory, we have to be realistic about where things go next. Many experts predict that if this keeps up, we won't just see battling budgets but outright economic stagnation. House prices are already correcting, and rising mortgage rates will further challenge home ownership. Corporate debt levels in the U.S. are soaring again, so refinancing will become much more costly, strangling company investments and pushing us into contraction. Stock markets might take a bruising as fears over long-term economic weakness grow. Remember how bond yield increases were one of the signals before the 2008 financial crisis. Let's face it, we're wading into a long-term sovereign debt crisis territory. As the situation continues to intensify, market stability erodes, confidence wanes, businesses cut back, and recession becomes an inevitable result. Trump's second term could kick off amid a full-blown economic disaster, one larger in scope than anyone predicted. Well, that's today's episode of Boss Economics World. In the meantime, don't just sit there waiting for policy miracles, they aren't coming. Protect your wealth wisely, stay informed, and don't be surprised by what the mainstream media glosses over. Share this video, subscribe, smash that notification bell, and let's keep digging into how government disasters continue to mess up our future. I'll see you next time.